Hello and welcome to the Can I Retire Now podcast with your hosts, Nick Russell and Becky Wagoner. I'm your podcast producer, RJ Malik, and Nick and Becky, it's fall harvest time. So I'm just going
It
to throw it
is.
to you.
It is, RJ. Um, Now, very cutesy title. I know exactly what we're going to talk about today.
Okay.
But of course, I lean on Becky, my incredibly lovely wife with a great sense of humor, to come up with our little, cute intros. This week, I honestly didn't get it. So Becky, how are we introing this?
Well, my idea was to say to you, what in the pumpkin patch does harvesting have to do with taxes? Or have you,
Okay.
gone out of your gourd? Um, I
Have I
think it's
gone out of
funny.
my gourd?
Yeah.
Okay. Okay.
I won't go
Hilarious.
as far as funny. It's
Oh,
it's cute, and
Yeah.
I think it's a clever play on words.
I
all
didn't think it
right.
was funny either, but not, but I'm not allowed to say it like that because I want to go home today.
Okay.
Um,
I will say
yeah,
you're the only person in my circle that I can say harvest to, and you think taxes.
hey,
This is going to
I
be
like to
thrilling
save
for
people
me.
money. Yeah, no, this is another episode where we talk about taxes. I know you love these. These are your favorite episodes.
Yay, let's do
Yeah.
it. Okay.
All right. So our goal here, just so you know, other than really bad pumpkin patch jokes, is just to show another way people could save money on taxes. An easy thing that a lot of investors miss.
Okay. And
So
what is it called?
it's called tax loss harvesting.
All right. The second word you're saying is
Loss,
L
like
O
losses.
L O S S. Okay. Because the first time you said it
LOSS.
to me, I thought you were saying laws, as in rules of law,
It is
or
a law. It is a rule. It's
okay.
also that,
Okay.
but it
So
has to do
tax.
with capital losses.
Okay.
Like when you lose money.
All right. So how can
You
we
would think
save
after
money?
all of these years you would know my accent.
Well, you said it really quickly because you were so excited to tell me about it,
I,
which is
I love
a
saving money on taxes.
unique perspective. So I'm interested in how you can save money by losing in
By
gains.
losing money. Yeah,
Yes.
yeah, yeah.
Okay.
Okay. So let's start with just some basic concepts.
Mm-hmm.
Here we are talking about, and for the remainder of this episode, are going to be talking about investment money that is not in a retirement account. So this is not IRAs, not 401ks. This is what we call non-retirement, non-qualified. It could be an individual or a joint account,
Mm-hmm.
um, but those types of accounts. So in those types of accounts, at the end of the year, tax time, people usually get a 1099 that shows that they made or lost money in interest, dividends, gains, or losses. So
Okay.
really simply, if we bought a stock and it went down and then we sold it, you would have a loss. If you bought a stock, mutual fund, anything, and it made money and you sold it, you would have a taxable gain, sometimes
Got it.
called realized gains, meaning you actually
Okay.
realized the gain or loss.
Mm-hmm.
So far, so good.
I'm with you. Yeah.
All right. So there is a tax law that allows you to write off up to $3,000 of losses every calendar year. So you get a little bit of a tax deduction if you've incurred losses over the course of the year.
That
Most
seems helpful.
people, yeah,
Okay.
it's something, right? And most
Mm-hmm.
people I find are familiar with that. And most accountants make sure that they're, putting that 3,000 in there.
Mm-hmm.
The the miss here, for both investors and I think sometimes accountants, is that they don't realize that that is a net $3,000 loss and not just a $3,000 loss you could take.
I'm no
Go ahead.
longer with you. What
All right.
what does that
Here,
mean?
Yeah, what's the difference?
here's the difference. Let's say, let's take recent history as an example. In 2022, the stock
Okay.
market and the bond market lost. They're the worst years we've had in a while, since 2008.
Okay.
Um, but since then, the market's been really good. So I imagine as we get here near the end of the tax year, that
Mm-hmm.
most people have gains in their accounts.
Yay.
Fair to say? Yeah, we've
Yes.
made money,
Okay.
right?
Yeah.
Great. So let's say we've made some transactions and we have $50,000 of gains, right?
It's a good year.
Taxable gains.
Okay.
So you would normally pay capital gains taxes on that, which for simplicity, if you've owned the investment more than a year, most people are going to pay 15% taxes. If you own it
Okay.
less than a year, it's less attractive. You're going to have to pay it like earned income, ordinary income, like you earned it on your job. So it could be a much higher rate.
Mm-hmm.
So what a lot of people don't realize is that, let's say back in 2022, you incurred $50,000 of losses. Well, the
Mm-hmm.
plan might have been, okay, well, that year I could take 3,000 of losses. 2023, I could take 3,000 of losses. These don't expire, by the way. You could take 3,000 every year for the next
Really?
15 or next 15 or 20 years. They're on the books. You earned
Okay.
them. Probably a terrible term to use, but
You
but
earned your losses?
you earned your losses. They're on your books. You can use them. But what people don't realize is, let's say you come to this year and you have 50,000 of gains.
Mm-hmm.
You can use all of your losses to write off as much or all of those gains all in 1 year,
All at once.
all at once. And if you have, oh, go ahead.
If it's
And
like 5 or 6 years, you can add that all up.
forever,
Really?
forever.
Oh.
Yeah. So, I, so I'll give a real example, which is kind of an absurd example, but I gave this one to Becky when we were talking about this episode. I have a real person, a real client I work with that we started working together in 2011. So
Mm-hmm.
big thing why I brought up 2011 is 2008 happened.
Yeah.
Everybody had losses during the financial crisis. So we started working together, and by about 2015, we had made an absurd amount of money on a taxable basis.
What a good
I
financial advisor you
no,
are.
the market made a lot. The market was
Okay.
super good then
All
too.
right.
So not just me, but so we talked and I said, hey, we need to reallocate your account, rebalance your account. And there's no way I can do that without you incurring $250,000 of gains, taxable gains, which at
Wow.
15% is like $40,000 of taxes he would pay. Now, of course,
Mm-hmm.
my client, I love him to death. He goes, well, you made me 250. I'll pay 40. We'll call it a day. I still made a lot of money.
That
Great.
seems reasonable. Yeah.
I said, before we pull that trigger, do you still have losses from 08? And he goes, oh, my accountant would know. I got on the phone with the accountant. Accountant says, yeah, he's actually got 300,000 of losses still on the books. So I said,
Yeah.
perfect. We'll be using 250 of that this year. So what we did was we took the 250,000 of gains.
Mm-hmm.
When he filed his taxes, the accountant took the first 250,000 of losses to bring that down to zero, and then took an extra 3,000 to get his $3,000 capital loss. The client went from paying what would have been about a $40,000 tax bill to getting a slight refund on his taxes.
What?
Just because yeah. And he would have never thought of that, because his idea was, I have 300,000 of tax losses. I'm going to take $3,000 a year for 100 years. And, obviously probably not live that long. And this is a real way to do that. Now, I will tell you, the market's been pretty good since the financial crisis. So we didn't really have a lot of losses for people to incur unless they, made some poor investments, until 2022. With the stock market and bond market down, people have losses on the books. And so now in 2023, which passed, but now 2024 tax season, they can make some adjustments to take gains and not have to pay taxes.
So this is
potentially
different than the $3,000. Why does it get confused? What's the difference? Is this something accountants do versus financial advisors? Like, or everyone just kind of stops at the 3,000? I don't understand why.
So most accountants, in my experience, and I would love to interview an accountant to talk about this topic, because most accountants see the 3,000 number and go, great, I'll make sure as long as it has losses on the books, we'll deduct 3,000. But then they also take the 1099 from me, let's say, and process all the gains. So make the client pay 100% of the taxes on the gains and only take 3,000 of it in losses. It's not right. It's something your CPA and financial advisor may need to partner up on to
Okay.
make sure that everybody's on the same page. But I have another client. We're doing it right now. He was a brand new client at the end of 2021. We started investing. The market went immediately down. We strategically sold things at a loss then that we knew we would want for future gains. And I'm not talking about selling out of the market and trying to time it. We literally just sold an investment and reinvested the money in something else right away. So we
Okay.
stayed invested, but we
Mhm.
locked in those losses.
All right.
And now we've had an amazing year this year. We're going to take some gains and not to pay any taxes on them.
And so that whole combination, selling at a loss or keeping the losses and then having gains later, is called tax
Tax
loss
loss harvesting.
harvesting.
Yeah.
Okay.
Yeah.
It sounds really helpful, especially if you have a financial advisor that knows how to do that. That could have some
And
real
should be
perks.
paying attention. Yeah.
Yeah.
Advisors should be paying attention to this stuff. Unfortunately, it's a new concept when I talk to people a lot. I'm like, oh, do we have losses on the books? And they're like, I don't know what you're talking about.
Yeah,
And I'm
because to
like,
me,
well,
it feels like, we wrapped up taxes. We did it all for that year. Like, they're gone. We're done here.
yeah,
Interesting.
but you don't get to, so let's say, let's say this year or next year, whatever, the market's terrible and we lose money and we take losses. So I'm not talking about holding an investment down and up. You sold something, you rebalanced, you took losses. Let's say we have $20,000 of losses this year. When we go to do our taxes, we're only going to be able to deduct the $3,000. So that other 17 is still lingering around.
Okay.
So now we're at a point where now most people should have gains. And if you go back and grab those losses and use them to counter those gains, you can use them all in 1 year. Still to the maximum of a net 3,000.
The 3,000 feels really good. It kind of stops your liability or whatever at losses.
Well, you think of it as a liability, but it's actually like a credit when you're dealing with taxes. It's giving you more deductions.
Taxes are so complicated.
I have a question, if you don't mind.
Sure.
So you have a year where you have losses, then you go back and you get those $3,000 each year. Now, let's just say you have the loss in 2020 and you take the 3,000 from 2015 to 2020. Now, 3 or 4 years later, if you then have a loss, you can't go back to 2015 and get that $3,000, right? Because you've already used it.
Yeah, you can't reuse money. But think of it like a bucket of water. So let's say you had losses and you started using them to write off gains, right? But there's still some money in the bucket.
I got it.
And now you have more losses. Pile those losses right on top. You get to now we have more losses we get to work off of.
So you don't look at it in the individual years. It's just a big number.
Yeah. So your gains you have to pay every year,
Right.
every tax year. Any gains you have, the IRS is going to say, thank you very much for making money. We want our piece. The losses, they don't care if you never take them because it's a tax deduction. So it's on you to be able to look back and go, oh, you remember that terrible investment I had? I lost $50,000 and now I have 47, 44, 41. Well, here's now a big earnings year. Let's go ahead and take a big chunk of that and knock that down to zero.
Okay.
Yeah. It's like a tax magic trick.
Yeah. Tax.
I felt like I just made a coin disappear.
I don't know.
Like,
and I just mimicked your hand motion like
you
that
did.
helps.
That was it.
I don't know
That
why.
was good.
Okay.
Yeah. So it probably sounds complex because I can tell by your reactions, but it's really just a simple equation. It's the gains you have minus any amount of losses you have up to that number. And then why I said it was a net 3,000. If you still have losses, then you get capped at showing 3,000 of losses.
That's what okay. All right. So what else can you tell us about tax loss harvesting, Nick? Anything else?
Tax loss harvesting.
Yeah.
So there is one issue that comes up with tax loss harvesting when people try to manufacture losses. So let's say, for example, we pick a stock, I don't know, Pepsi. And, Pepsi, let's say, is down. And so we go, ooh, we want to lock that in as a loss so that I can write off all these gains I had in other holdings.
Okay.
So people will sell Pepsi with the intention of buying Pepsi right back because they want Pepsi. Problem is there's something called a wash sale rule. Wash sale rule.
Yeah,
I'm gonna enjoy
following.
this.
I'm following. Yeah.
That says if you buy a stock, sell a stock, you cannot buy it back within 30 days and appreciate those losses.
Oh, so people were trying to game the system, like, oh, it's down. I want to, counteract some gains. I'm just gonna sell it and sneak back in. That's not allowed.
Yeah. Sell it today,
Okay.
buy it tomorrow. No. Now, let's be honest. There's so many investment options out there. You could sell Pepsi and buy Coke for 30 days and then sell Coke and buy Pepsi back. And you're not going to negatively affect your
But the rule is 30
Pepsi.
days for the same
30
investment.
days.
Okay.
30 days. And by the way, if you make that into more mutual funds and ETFs and these broader based investments, let's say you have a technology ETF and you sell it, you can buy a different technology ETF. And then you can literally own almost the same thing, but get the tax loss.
So that's called wash.
It's called a wash sale rule.
A wash sale.
And if people look on their 1099s for these accounts, their 1099 tax form, there's a little thing that says wash sale. That'll come up. So, and hopefully those all say 0, because if they have numbers in them, you don't get to use them. You don't get to take those losses. Basically, it makes it like null and void.
Okay. So how much are people usually paying in capital gains taxes?
Okay. It's a great question. So as of today, because this has been a very political thing over the last few elections about raising capital gains taxes and all that. As of today, most people pay 15% on long-term capital gains. So it's important to know, I made the distinction before, it's considered long-term if you've owned the investment at least a year. So in all of these examples, by the way, if you've owned the investment less than a year, you're going to pay taxes as your ordinary income, which could be 22, 26, 28, 30%. Another reason, just a little shout out to why day trading doesn't make sense for a lot of people. If you do all this buying and selling throughout the year, yeah, maybe you make a little money, but your tax liability is going to be at essentially the highest rate you pay.
I was going to say, is that the same for real estate? Don't you have to own real estate 2 years? Or are those different capital gains?
I think it's a year.
It's a year as well.
It is only a year.
The 2-year rule is something different that you're thinking about.
Okay.
We had that with a condo. We bought a condo on Cape Cod, and the neighbor below us was the neighbor from hell. So we ended up getting rid of it, but we got rid of it just over a year of owning it. So
367 days. Yeah.
Yeah, that's all it takes.
Yeah, at first we thought we were going to get crushed, but it worked out really well for us. But yeah, it's a year.
Okay.
Yeah, and now let's say you owned it and you happen to lose money on it. Well, now you have capital losses
that I can harvest.
That you can harvest. Okay. So most people pay 15% on their capital gains, long-term capital gains rate. But there's actually it's based on the amount of income you make. So I have a little table because there was no way I was going to remember all this. But to give you a quick and dirty kind of thing, if you are single, you pay 15% long-term gains on any income from about $47,000 to about $519,000. That's for 2024 in income. So a significant part of the population.
A lot of people,
if you're married, it's 94,000 in income to 583. I highlight those in particular. If it's over that, by the way, good for you. Feel free to reach out to me, sunrisewealthadvisors.com.
Oh, if you make more than $500,000 a year.
If you make more than $500,000 a year, we'll find something to do.
Yeah,
we'll find something to do with that extra money.
Okay.
But you'll pay 20% tax rate. The nice thing about this is if you make less than that, you actually pay 0% on your capital gains. So I highlight this because we always try to figure out, well,
Yeah.
how does this pertain to retirement? And it pertains to retirement in two ways. One, of course, if we could be saving money on taxes all these years and not
Mm-hmm.
have it be this friction that stops our money from growing, that's great. But now imagine in retirement, when you do have less taxable income traditionally, there are plenty of married couples that have under 94,000 in taxable income. And I stress taxable because you may have some tax-free income as well from a Roth IRA or something
Oh,
else.
the tax triangle. Yes. Yeah. Okay.
Yeah, I know.
Yeah.
So if you're less than 94,000, it's actually 0%. So
As a
you
couple.
may
Okay.
now, as a couple, so now here we are closer to the end of the year, you may want to look at your accounts and go, hey, I feel good about the market, but I still may want to lock in some of these gains and because I don't have to pay taxes on them.
Oh.
Now, there's a lot of moving pieces there. The moment you
Yeah.
take those gains, and based on your income, it may affect your Medicare premiums. It may affect your Social Security taxation. There's a lot of moving pieces. That presentation I gave a couple weeks ago was all about that aspect of it. Um, so this is not something to just listen to us on the podcast and go willy-nilly trying to take gains, but this is a real conversation you should be having, especially now at end of year with your financial advisor and your accountant to try to really minimize what I think is wasted money. I called it a leakage the other day to Becky. I always think of like money in this jug, and if it's full of water and you just poke a hole in it, investment fees, taxes, those are all leakages. Like you're gonna pay taxes and you're going to pay fees on your investments. But if we can minimize those, the it's a much better chance that you're dumping more money in the top.
And you're
Your
filling it up.
bucket's going to
Yeah.
fill up. Yeah.
And grow.
Yeah.
Okay. So that's good information. I had no idea what tax
Was
loss
that
harvesting
crazy?
was.
Was that tax loss harvesting? Was that a reasonable explanation of what might be a little more of a complex topic?
Yeah, I think I'm the barometer. If I understand it, then everyone's going to understand it, and I
There you go.
understood it.
We
Okay.
have a good barometer to work off of there.
Yeah.
I have one other thing I was
Yeah.
thinking of sharing.
Yeah.
Important because this is something now that is exactly the same thing we've talked about, but you have zero control over as an investor. Is if you, I know, you look so unhappy.
Helpful. I know. I just go ahead.
If you specifically own mutual funds in your accounts, again, in your non-qualified, non-retirement accounts,
Okay.
the mutual funds are a portfolio of stocks, bonds, cash that company A, C, whatever, Vanguard, Fidelity, you name them, they're buying and selling throughout the year for you and over the years. And most mutual funds are meant to last forever. So things are always happening. Starting literally this week. So by the time this podcast comes out, people probably would have already gotten the notices. But those mutual fund companies, instead of them paying capital gains taxes on their gains versus their losses, they're allowed to legally push them through to us as investors. So you may get a notice in the mail from a mutual fund company that says, here's a summary of our capital gains pass-throughs, is what they call them, for the year. I've started getting them here at the office because I get them from like every mutual fund company. And they will tell you per share that you own how much you're going to show in capital gains taxes.
And not them.
Not them. They're allowed to pass them through to us.
The gains and the losses.
Just the net gains.
So they're gonna harvest the losses, but pass the
well, they will
gains
against
on
those
to the
gains.
individual.
Against those gains. So don't worry, they're not like really sticking it to you. But when there's big net gains and there's no losses to take against them, they just casually push them through to you.
And that's allowed.
It's 100% allowed, happens every year. And a lot of times, if you go through the history of like mutual funds, if you're on like Yahoo Finance or looking at a chart, you'll notice in November specifically, because that's kind of the big month for it, sometimes early December, you'll see a mutual fund that, let's see if I'm doing it your way, is just ticking it along and then just drops like 8 or 9%, the principal value. That's them passing through the gains to you. Now, what they do is they drop the price, but up your your cost basis or the price you've paid. So they're forcing you to pay those gains. So you have to be aware of that while we're talking about all of this. So this is where it starts to get like really ugly and really
That's really
complex.
a
And
lot of information. Yeah, that
yeah.
seems better for you to handle.
So if you look at Becky's face and that like slightly disappointed, like I bought her a vacuum for her anniversary face kind of look,
That's
that's what
exactly.
people, yeah,
It
that's what
feels
people
really
are thinking.
sly, like, and subversive. Like,
Yeah.
okay, you're trying to help
So
me, but you want me to take care of it. Mm-hmm.
yeah. And so there
Okay.
are, and look, mutual funds are great investments, just like there's an investment that's right for everybody, right? But it is why, like personally, we drift towards exchange traded funds, known as ETFs or individual holdings, because then we only pay taxes on those capital gains taxes when we buy or sell them. So the mutual fund, by the way, they'll pass those capital gains every year, but then that had nothing to do with you buying or selling the mutual fund. That just happens. Then let's say
Okay.
you sell the mutual fund, you could pay more capital gains taxes because now you've taken a gain on the principal value. So they're not the most tax friendly
It doesn't
investments.
sound friendly, like friendly behavior. I'll say that. But
No, which is
anyway,
why I don't buy you a vacuum for our anniversary. It doesn't,
it's a
it
good
just
move,
doesn't
sir.
sit well. Yeah.
Yeah. Yeah.
Yeah.
All right. So I have a grip on this, but I do have a interesting fact. I hesitate to use the word fun when we're talking about taxes, but I have a fact for you because you said this to me, and I was like, I don't know what this is. I'm a relatively informed individual. Um, when did this start? So I looked it up. How long has tax loss harvesting been around? Turns out it's been around from the beginning of income taxes, which started in
How about that?
1913, in case anyone's wondering, because we definitely didn't celebrate the 100 years of taxes in
Yeah,
the
that kind of
country.
came and went. No one
It
talked
didn't,
about that.
no one even, they're not even a blip.
Man.
Okay. And so tax policy was written with this in place from the very beginning. And so it's interesting that this many people don't know about it. In general, I'm sure the right people know about it, but like it's not common for me at least. Tax.
It's not common knowledge.
No.
It isn't. I would tell you that most of my clients or the people that I've interacted with over the years, I would say 4 out of 5 had
Mm-hmm.
never heard of this concept prior to working with us. And yeah, I mean, and it's not for lack of knowledge or capability, or maybe there's a lack of knowledge, but I mean, it's like I think it's become one of those things that, like you just said, it was around from the beginning. Did it become like an only uber wealthy thing to
No,
do?
I think my personal opinion, and I have no idea because I was not around in 1913 when they wrote these laws, but I feel like it's one of those things like if you're in the know, you know, and we're just going to keep it, we're just going to keep it here to ourselves. Like, so it's definitely meant to be known by
Yeah.
the people that it benefits, if that's the right way of phrasing
Yeah.
it.
Isn't it like that meme about the IRS where they're like, the person's talking to the IRS agent and he goes, well, how much do I owe in taxes? He goes, well, you have to figure that out. He goes, well, how am I supposed to figure that out? They're like, we don't care. He goes, well, what if I'm wrong? He goes, well, then we'll give
Jail.
you a penalty.
Yeah.
Yeah, but you go to jail. But he goes, well,
But
how do
you
you
already
know that
know?
I'm wrong? Yeah, he goes, because we have software that we use for it. He goes, well, can't you just figure it out and tell me and I'll happily pay it? And they're like, no, that's not how we function. So it's
Yeah,
something you like need to know.
that's what it feels like.
I never thought about it that way, but you're absolutely right. It's not hidden, and it is a beneficial tax law. Like if you have to pay taxes on gains, then go ahead and get a write-off when you incur losses. That seems super reasonable to me. But if people don't know they could take all their losses, like my client that had 300,000 of losses, he's not going to live 100 years to take all those losses, 3,000 at a time. But yeah.
So while everyone's going out and enjoying the fall harvest and getting your pumpkins and turkeys and enjoying the leaves, don't forget to gather your tax loss harvest as well. Maybe not funny, still not funny. Okay.
Oh, good gourd, Becky.
Good.
Good
Oh,
gourd.
see?
Wow.
See, I think it works in response, maybe, but yeah.
No, it didn't work,
No,
Nick. I'm
no, it still
sorry.
didn't work.
Okay. Two wrongs
Well,
don't make a right.
I'm
no,
just gonna,
two
yeah.
dad jokes don't make a podcast funny. Yeah,
Okay.
so maybe again, it's taxes. It's not the most rainbows and butterflies thing to talk about, but this is
Never.
real. It's a real amount of money
Yeah.
that people could save by just being
That-
aware. And because we had a down year 2 years ago, people should have made money the last couple of years. This would be an opportune time for a lot of it. We're doing a ton of it, more this year, honestly, than we have done in probably 6 or 7 years in our office, going through
Okay.
clients' accounts and doing some tax
So
loss harvesting.
so that's the homework is if you have gains this year, maybe go back and find a year because they're good forever. All your
Good
losses, you
forever.
just keep them in your pockets until you use them. Okay. And see if maybe you can reduce your taxable income liability.
Look,
Some
everybody
fancy
knows when they
word.
lose
Yeah.
money, right? Like it's psychological, right? It affects you when you lose money like 10 times more than when you make money.
hmm
You probably lost money in 2022. Start there, right?
Okay.
And let that be the start, right? And see if you lost money. Look at your 1099 from 2022. You may not need to go farther back than that. Heck, the market was really good for most of the decade prior, so hopefully you didn't lose money back then. But it also could be one holding. Like you might have 95% of your portfolio, but you have that one holding which just you took a flyer on and it stunk. You bought marijuana ETFs years ago and now they're worth like nothing. Sell it worth nothing. Take the loss if you have gains that you don't want to pay taxes on. Full disclaimer, I am not a CPA or an accountant. You must seek your tax professional for advice and all of that. But
Okay.
look at it. I
All
don't know.
right.
I don't want people to assume I'm a CPA or something. So,
No. No.
um,
All right.
but your accountant and your advisor should be helping you with this.
Okay.
This
Go
has
save some
been,
money.
yeah, this has been interesting and enlightening. So thanks, Nick. Tax loss harvesting.
By the way, if it's this interesting to you, I have a whole write-up I can share with you tonight when I get
Oh,
home.
you
Like, what are
know,
you
I
doing
have
Friday night?
things to
What are you doing
do.
Friday?
I have plans
Crack
that
open a bottle of
day.
wine, talk about tax loss harvesting. Come on.
Wow.
Come on, Becky.
Yeah,
Yeah, I know how to
that's
treat a lady.
I'm busy. I'm
Yeah.
busy during that time. Sorry.
That whole time? All of
But,
that time. Okay.
but
Maybe
yeah.
maybe next weekend.
All
Okay.
right. How about some contact information, Nick? How can people get a hold of you?
All right. Contact information, all found on the website. We have a whole podcast section there, which has all the episodes, of course, and ways to get here, but also pieces that kind of we've referenced during the episodes. So that's sunrisewealthadvisors.com. We're also on every social media platform. Well, not everyone, I guess, but most of the social media platforms, Facebook and X and LinkedIn. And all of that. So yeah, if people have questions, we have a nice little question box there on the website. Just reach out. Happy to help.
Sounds good. All right. Looking forward to your next podcast, and thank you for listening to today's Can I Retire Now podcast. Until next time, for Nick and Becky, I'm RJ Malik.